Okay, we're going to go ahead and start our webinar, and this is on the Coronavirus Economic Update, March 2020. Good afternoon, everybody. My name is Tony Lajana, CEO and President of TL Financial Group. I hope that you're all doing well and staying healthy during these extraordinary times, and they are. Before I begin, I just want to go over some housekeeping items. Today's webinar should take about 30 minutes. I do have everyone on mute since there are so many people in the webinar today. If you do have a question for myself or my staff, please email or call us. We're available to you. You can find our emails on our website at tlfinancialgroup.net. There will be a replay of this webinar, which will be emailed to everybody, all of our clients. And it will also be found on our Facebook page at TL Financial Group. So if you haven't already, please follow us on Facebook. All right, this pandemic has caused economic harm that has not yet really revealed itself in the numbers, but I believe it is a far gone conclusion that the numbers will not be very encouraging. So my goal today is really to help you make sense of what's happening, and more specifically, what we're doing at TL Financial Group about the current market conditions, how we're positioning our assets, and then of course, we're going to have Christina Perna, our operations manager. She's going to provide you important information on how we plan to operate as an efficient office for you. Okay, let's get started. On March 12th, our portfolios were moved to a capital preservation model with an emphasis on maintaining capital, preventing long-term impairment, and lastly, adding further protections in a very quickly evolving high-risk environment. This is consistent with our investment process discipline. Now what we need to do is stop, assess what we expect since the US has moved to implement their far-reaching containment efforts. As emotionally disrupting as the last couple of weeks have been, it's really important to stop and remind ourselves that the virus spread will end. It's going to end either by successful containment measures, new medical treatments, or simply the change in weather towards summer. The spread of the virus will ultimately have an end date. The problem, though, is that we're dealing with now is that we don't know when the outbreak is going to peak and when life can start moving back towards some sense of normalcy. And really, this is the big question. Containment is still necessary. There is a lot of criticism regarding the proportionate response based on statistical threat that the virus presents. However, for countries committed to stopping the spread, containment efforts will continue to be enforced to greater degrees. So despite our unhappiness with the closures, it is a simple fact that social distancing really does work. Obviously, the disease cannot spread between people who are not in contact with each other. So as numbers of the virus increase, and they will, we will likely see more closures and restrictions in the US in the coming weeks. Containment does have economic consequences. While the closures and suspended events are shocking to our senses, the more dangerous impact is to the economy. Quite simply, ripple effects are being felt across various industries and sectors. The widespread shutdowns, restrictions, and cancellations lead to large volumes of people out of work, which reduce spending, and companies experiencing financial distress. Every action has a consequence, and each consequence has another consequence. So we are most concerned about developing the second order impact to the US economy and the risks that may come to bear. The economic consequences of containment efforts will start showing up this week and next week. This is not a fear-based statement, but a reality-based one. Here's where we expect the hits to start appearing. First is increased unemployment. Due to cancellations in the travel industry alone, unemployment data will increase significantly. There's also a wide ripple effect to related businesses such as restaurants, bars, non-durable goods, etc. Furthermore, it is easy to assume many businesses will begin a hiring freeze as long as uncertainty remains high. Second is decreased manufacturing activity. The clear impact to demand means producers must immediately start slowing down. Survey data will begin reporting this coming week. Our expectations are for declines consistent with pre-recessionary levels. And then decreased retail spending. Retail spending will decline at both big and small levels. Large businesses like homes, autos, and major appliances will get deferred as consumers deal with the immediacy of what's going on. Smaller level purchases will shrink simply due to the lack of availability caused by closures. Secondarily, gasoline prices have plummeted, and this too will create a year-over-year decline in revenue. It's estimated that 74,000 companies have closed so far in the United States. There is some economic data that is coming out this week. Today, new home sales are going to be reported. Wednesday, you're going to see durable goods. Thursday, we're going to see what the fourth quarter GDP numbers are, and we're also going to look at jobless claims for unemployment. A reasonable expectation is for about 1.5 million layoffs, which would dwarf the 2008 and 9 recession. And this is actually probably just the tip of the iceberg. Lastly, on Friday, consumer sentiment will report, and we expect that number to not be very good as well. So it's going to be a busy week of reporting, and we expect all the data will reflect the realities that you're experiencing and that you see all around you. Okay, further major policy support is on the way, which we're seeing today. Policy leaders are already exploring just how far they can go and what level new measures are needed. So the Federal Reserve exercised a bold move to lower rates back to close to 0%. As further diminished activity is revealed, and the federal government has taken an unprecedented move by signaling unlimited quantitative easing that we saw in 2008. And there will be new fiscal spending as well. Congress is already underway with pushing through the coronavirus emergency package that may include additional support for strained industries and small businesses, which we hope to see later today. That is why the stock market is surging today, but I'll have more to say about that in just a moment. Legislators are also likely to push a payroll tax cut for wage-earning Americans, and the tax filing season has also been pushed to July. So I want to review this market volatility and really explain these 3 bullet points here for you, because we are going to have more market volatility that we anticipate moving forward. So there's this push-pull effect of good news and bad. A series of bad data days lie ahead. Metrics will likely plummet to levels consistent with past recessions and shake confidence. On the other hand, new supportive policy moves will embolden investors to maintain faith. The battle on this sentiment will continue until things stabilize, which I believe is what you're seeing today in the market. History's example: there is little historical precedent to look and learn from what comes to major market moves of this type. We're just this is like a black swan uncharted territory event. However, in 1987, it took 2 to 3 months of sideways activity before markets generally stabilized. And then in the shock of 2011, a similar path emerged from August through December. So it took some time. So expect months of volatility, not days. Because the virus numbers will likely worsen before getting better, uncertainty will remain high for a considerable amount of time. Furthermore, it will take months to evaluate the damage and assessment to the real economy. So I put together 3 potential paths to consider. First one is going to be the upside scenario. So this is like the best case scenario that we would see. Strong compliance with social distancing measures coupled with viral seasonality, which is, the virus doesn't spread as well in warmer weather, and or pharmaceutical breakthroughs could enable the US and Europe to see infections peak by mid-April. If so, sheltering mandates could be relaxed starting in early May, meaning that government stimulus would be sufficient to prevent lasting economic damage. This could provide the backdrop to a V-shaped type of recovery in this year's third and fourth quarters, with the S&P 500 index ultimately trading at roughly 2,900. It finished Friday at 2,300. So this is a possibility in the best case scenario, we think. Scenario 2, which is a central U-shaped type of recovery, much like the upside scenario, new virus detections peak in mid-April and sheltering restrictions loosen in early May. But the virus isn't completely eradicated in this scenario, and sheltering restrictions are reimposed when needed in certain countries throughout the year. So softer restrictions could be in place for the rest of the year, while coordinated monetary and fiscal responses from central banks and governments will provide the necessary funding to support affected businesses and industries in this scenario. It will arrive too late, though, to protect all of them. This would provide a U-shaped type of recovery that takes hold in the fourth quarter, putting the S&P 500 around 2,600 by year end. Or scenario 3, which would be the worst case scenario, and that is an L-shaped, downside L-shape. Here, containment measures are too late, and the new virus infections keep rising in the US and Europe into May and June, keeping most sheltering restrictions in place until June or July, and possibly intermittently for the rest of the year. In this scenario, government policy would not meaningfully offset the lengthy demand shock, leading to sharp rise in bankruptcies and joblessness. Companies would forego significant revenue, and losses would be borne by shareholders, creditors, and banks. If this happens, an L-shaped growth profile for the remainder of the year could happen, and by the end of the year, you could see the S&P trading at roughly 2,100. But if past bear markets are a guide, it could close lower than even that. So the three scenarios set up an interesting paradox. Broader containment efforts feel harsh, but faster containment gives the economy a better chance of a quick recovery. History will tell which one will play out. So I wanted to provide some capital preservation expectations with regards to how we're managing your assets at this time. Our goal is maintaining capital until risk is lowered. Under current circumstances, we gauge core economic risk to be significantly high. The expected result is continued market volatility and potential exposure to further sizable declines as stock prices adjust to the changing economic situation. Because of this, we will remain in capital preservation mode until we assess that the risk environment declines. Our current allocations are consistent with a bear market strategy. Our portfolios consist of government treasury bonds, gold, and cash. On March 12th, when we went defensive, the S&P 500 was at 2,738. Yesterday's close was at 2,237, which mitigated an 18% drop in our clients' portfolios. We really want to minimize risky bets. Now is not the time to make risky bets. The near-term future is far too uncertain. Our mindset is geared towards preserving capital and looking for investments with historical reliability as a place of safety, which is going to require rigorous monitoring. Obviously, our existing monitoring systems are helping us incorporate new data as it's released. We're going to continue to evaluate a wide range of investment considerations as the situation continues to evolve. Okay, so what can you expect from our office as it relates to communication and our procedures? As you know, the whole state of Michigan is on lockdown until approximately April 13th. So what can you anticipate? You can expect frequent communication through email, video, webinars, Facebook, etc. For your financial reviews, expect online financial reviews for the foreseeable future. And of course, the safety of our clients and our team members is a priority. So at this time, I'm now going to turn this portion of our webinar over to Christina Perna, our operations manager. She has been doing an excellent and outstanding job that we have, that she has been putting in place to provide a super smooth operation to serve you during this time.
Thank you, Tony. I hope everyone is doing well. As Tony said, my name is Christina Perna, Operations Manager. We began remote operations this week. So what does that mean? Each team member has a company laptop. These laptops have password protection, encryption, and virus software, which is updated regularly to protect our clients and their data. Our phone system is designed to redirect calls while we are working from home. So if you call our office during normal business hours, you can expect to hear one of us on the other end of the line. Mail is picked up daily to ensure any important information that was sent to us is processed quickly and efficiently. We also have a secure drop box attached to a front pillar by our doors. Please feel free to use this drop box as it is also checked daily. A majority of our paperwork is able to be signed electronically. If there is a form that requires a client's signature, we have the ability to send this document to you via email. It's an unusual feeling not seeing the people I work so closely with on a daily basis. Thankfully, with the help of technology, we are able to continue communicating with each other to allow us to support our clients and stay available to them during this time. So if there's anything you need, opening a new account, depositing or withdrawing money, or to make changes to your account, please contact us and we will be happy to help you. Thank you for your continued trust in all of us at TL Financial Group. I have faith that we are going to make it through this, and I look forward to seeing all of you soon. I hope you and your families stay safe and healthy. Thank you, Tony.
Thanks, Christina. Okay, with that, I want to say thank you very much. That concludes today's webinar. We do have a couple more planned in the future. You will be notified by email or by our Facebook page. So if you have not already, please go to our Facebook page so that you can follow us, because we also put updates there as well. The economic environment is literally changing by the day, if not hour. And we are doing our very best to monitor and navigate everybody through this historic event that we are all in together. So again, I want to echo the words that Christina said. Thank you so much for the trust that you place in us. We are going to get on the other end of it, and I look forward to that day. And so in the meantime, if you have any questions or you need to reach out to me or Michelle or Aaron, any of the staff members, please email us or call us. We're available to you. Obviously, give us a little bit of time if you email us to get back to you, because we are trying to communicate with everybody as efficiently and effectively as we can. Again, you guys, stay safe, stay healthy. We care deeply about all of you. I pray that you and your families and friends are all doing well during this time. And again, I look forward to seeing you when all of this is over. With that, I'm going to conclude our webinar. Again, if you have any questions, please reach out to us. We're here for you. Thank you.